Everybody, welcome to Cigars and Syndication. I'm Robbie Rogers. I'm here with Jay Knorr, and we're very passionate about cigars and real estate investing. And today we're going to hit on some topics that I think you're going to find very interesting.
Hey everyone, my name is Junaid Noor. Welcome to Cigars and Syndications. Today we are going to hit on a topic that is in the news, which is the whole fiasco with Crowdstreet and Nightingale properties. But before we get into that, what are we smoking?
Today we're smoking a Davidoff 10-year anniversary in Nicaragua. Um, so far, really good smoke, a little bigger ring gauge than the normal Nicaragua, but nice peppery and a little sweet, maybe sugar, maybe coffee flavor that I'm getting right off the bat.
Yeah, I'm getting a nice pepper as soon as I lit up. And again, I'm always a big fan of Davidoff. The Nicaragua, especially, is one that you like, but this is a 10-year anniversary special edition. How many boxes did they make of this?
I don't even remember how many boxes they made. I know it is a limited number. Maybe one of our tech guys could let us know here shortly.
I thought I read something like 3,200 boxes.
Oh, okay. That does sound right.
Yeah, but yeah, I get some chocolate, some leather, dark brown sugar with the chocolate mix. So it's got a very nice uh, bitter chocolate, but a little bit of a sweet hint to it.
Yeah, I think maybe it's probably getting some of that sweetness from the rum barrels. I believe it was stored in rum barrels for a specific amount of time, and really has a good flavor.
Oh yeah, I'm a big fan of Davidoff. I am a fan of this Nicaraguan. It's a very full-bodied, strong cigar. Make sure you have a really good lunch or dinner before you smoke this, so you don't get lightheaded, especially if you're a new smoker.
Well, we're going to talk a little bit about Crowdstreet and Nightingale and some fun things like that today. Jay, what do you know about Crowdstreet?
So let's start with crowdfunding. Crowdfunding started in 2012 with the signing of the Jobs Act. And basically, what it did was it allowed smaller investors, you're talking about $1,000, $500 investors, to start getting non accredited investors to pull their money together and invest with a platform into different aspects. So there's all these different types of crowdfunding, right? I mean, we know Kickstarter, which is a crowdfunding platform for new business ventures. We know of CrowdStreet and Realty Mogul are two of the crowdfunding platforms for real estate. We also know of some of the non-for-profit crowdfunding like GoFundMe, which is for somebody's having surgery and they need to raise money for their surgery, and people kind of just chip in and help them raise money. So basically, crowdfunding platforms were given the ability to not necessarily file with the SEC, not necessarily be under the SEC rules, not have to deal with the accreditation and blue sky laws of any state, and be able to raise small amounts of money for different aspects. Now, CrowdStreet in particular raises money to invest in real estate deals.
Well, it's really interesting, and you'd mentioned accredited investor, and I think the way that these groups, market their fundraise or their capital raise is it gives the small guy a chance to be a part of a bigger project. But maybe delve into the accredited versus non-accredited and how that, impacts how they have to report all this.
Right. So an accredited investor has to have certain net worth. I believe either $1 million of net worth or $300,000 of income over the past 2 years. Basically, the SEC wants to make sure that if you're investing $50,000 or $100,000, you have enough knowledge to know what you're getting yourself into. You're not putting your life savings in. You're not, if you lose the money, it won't really hurt you. A non-accredited investor is somebody who doesn't meet the criteria of the accredited investor. But again, we get into different criteria. So for example, let's say we have a real estate deal coming, and we're gonna only go with accredited investors. So, if our minimum is $50,000, we only look at accredited investors, and we can market to them openly as long as we are only receiving our funds from accredited investors. Now, we can do a mix where we could do up to 35 non-accredited investors. And basically the SEC gave that leeway. Let's say my mother wants to invest. She's not an accredited investor, but she's like, hey, you're my son. I have a relationship with you. I know what you're going to do. If you lose my money, I don't care. Or my uncle wants to invest. So the non-accredited portion allows people who you have a relationship with to be able to invest in your deals.
Is there any time consideration in that, or is it just an established relationship prior to the fundraise?
No, it's just an established relationship. And then, there are some checks and balances where the sponsor, which is us, it is our duty of care, our responsibility to make sure that we understand that person's, the non-accredited investors' investment criteria, and to make sure that, they're not getting into something that they don't understand.
And that completely changes how you market and advertise and solicit for funds.
Correct. And we did a whole podcast. If you go back to our website at www.albany Park Capital, or if you go to YouTube and you go to the Albany Park Capital and subscribe to our YouTube channel, we did a whole podcast on the differences and the details between accredited investors and non-accredited investors.
Well, Jay, you just put out an article about Crowdstreet and Nightingale, and maybe explain the dynamics of that situation.
So now let's talk about Nightingale Properties. And then we'll bring the two together and let our listeners know what happened. So Nightingale Properties has been around since about 2005. They are a real estate investment firm, just like us. They get investors together, they buy real estate, and they've had millions of dollars worth of millions of square feet and millions of dollars worth of, actually in the billions, of real estate spanning over 22 states.
I mean, that's incredible. I mean, from 2005 and accumulating that, and they use the syndication or capital raise method to acquire these properties, or did they focus mainly on commercial?
Yeah, mainly they focus on commercial, and so they have a pretty decent track record. They've been around for quite some time, but this is a very interesting time that we live in, and we've done podcasts and YouTube videos on the future of the real estate market. And again, if you go to our subscribe to our channel on YouTube, we have done other videos on the future of the real estate market. And this is a very precarious time because after COVID and after the work from home, office buildings are really just in a bad situation.
Yeah, they're still recovering from 2019, and there's a lot of people concerned about the commercial real estate market today, and I think it's probably justified. The banks are getting scared.
So the issue came up when Nightingale, a well-known, well-established investment firm, approached Crowdstreet, which is a well-established 10-year-old crowdfunding platform for real estate, and said, hey, we have these properties in Miami Beach and Atlanta, and we want to use your platform to raise money for our investors. And so Crowdstreet agreed, and they raised $60 million from 800 different investors.
Wow, that's a lot of money. And then I guess CrowdStreet's involvement was simply getting this information in front of its viewers or its customers to raise money for property acquisition.
Exactly. So CrowdStreet has, 100,000 investors. And so CrowdStreet vets the deal and puts it up on their platform, and 800 different investors raised $60 million. Now, here's the conundrum. The deals in Atlanta and Miami never closed. And when CrowdStreet sent an independent investigator to find out what happened, the money's gone. Nobody knows what happened to the money
So they have 800 customers out of their money.
out of $60 million. And so now the SEC is involved, the FBI is involved, everybody's investigating, trying to figure out what's going on over here.
So it's kind of interesting that, if I was Crowdstreet or a capital raiser, you know, they probably thought this was a home run when Nightingale approached them. But then maybe they should have asked themselves, if they've been doing it this long on their own, why do they need me now?
Right. And that is a very good question, amongst other questions, because as I was writing the article for our webpage, I just started doing some research on Nightingale and found out that Nightingale has a lot of office buildings in Manhattan, which are in distress. And there's a lot of opinions out there, not my opinion, but a lot of gurus whose opinions are that, well, CrowdStreet could have done a Google search. CrowdStreet could have delved more deeply into Nightingale's financial distress situation and done a better job of due diligence.
Right. We harp on that all the time, and doing your due diligence, being conservative. Maybe they were just focused on the deal itself instead of the end customer or the end developer.
So, again, with my Google search, I found out that Nightingale has one of its largest properties in receivership. It's got two more properties that are on the foreclosure auction block. And then it sank $500 million with a B, dollars into a Manhattan skyscraper, which is completely empty. So, and if you go to the article that we posted, I have a link to CrowdStreet's vetting process, and they have a pretty good vetting process. They vet the documents, the legality of the documents, and the structure of the corporation. They vet the sponsors, and they vet the deals, and they've done a pretty good job so far. So what happened here?
Yeah, that's going to be a legal nightmare trying to untangle that, and you know, I would hate to even speculate that this thing was put together with bad intentions, but it doesn't seem like everybody did their due diligence.
And it may just be, CrowdStreet gets a fee for a percentage of the money raised, and they just felt it was a slam dunk because Nightingale is a well-established company. But well-established companies are in trouble. Brookfield Asset Management turned over, in one of our previous podcasts, we talked about this. They turned over keys to office buildings in San Francisco. And Brookfield Asset Management is a large, multi-billion-dollar public entity. So lots of people are in trouble, and I think that, for CrowdStreet as well as for individual investors, right? Make sure you understand who the sponsors are, what their track record is, and kind of just look and see if they're in distress. If they own office buildings, and they own a lot of office buildings, chances are they're in distress.
Well, while you're doing your due diligence homework, you should definitely grab you this Davidoff smoke. Really good smoke. It's mellowed out, lots of flavor, lots of bold flavor. It's burning magnificently. Really enjoying this. It's a good smoke.
Look at that ash. Can you zoom in on this ash? Look at this ash.
That's a nice ash.
I've been told that many times that I have a great ash. So as a result of this fiasco with Nightingale and the due diligence process not being followed, Torstein, which is the CEO of CrowdStreet, has resigned.
Well, how does this even happen? How does $60 million get misappropriated?
So the way CrowdStreet does it is that as soon as investors start putting money into CrowdStreet's escrow, CrowdStreet releases it to the sponsors. And now what they've done is they've amended their escrow policy to say that, look, we're not going to release funds to the sponsors until the deal is closed. So if you take our the way we do things when we raise money for investment projects. We do a capital stack, and we do a combination of debt and equity. And because we're in the development space, what we normally do is we go ahead and we purchase the land ahead of time. And then this way the deal is already closed. And then when we close on the loan for the development portion, that's when we take the money, the funds from the escrow of our investors, and use that towards the closing. In cases of when properties are purchased, the same way, it should happen the same way. The money should sit in an escrow account, and the sponsors should not be able to touch it until the deal closes, because it gives the sponsor the ability, if you don't do it that way, to move funds around.
Right. Yeah. I mean, you shouldn't be able to utilize that money for anything other than its specific intended purposes.
And that is one of the SEC requirements, but there's no requirement that it sit. For example, when we go to close a deal on our land, the money that we give for a for a deposit, the earnest money, sits in escrow with the title company. And the title company doesn't release it to us until closing. There's no requirement by the SEC to do that. And that might be something that they may want to start doing, or if a lot of these events start happening. Right now, because crowdfunding is so young, we're all pretty much self-regulated. I mean, there's an SEC audit that could come in and things like that, but we're self-regulated, right? Are we getting accredited investors? Are we following the rules of marketing towards non-accredited investors? Unless somebody complains, we're pretty much self-regulated right now. But if this happens a lot, maybe the SEC comes in and says, hey, investor funds need to sit with a third-party escrow company until closing.
Is there any way you could protect yourself as a small investor? I mean, do you have the potential to see those types of things in the contract? Can they be spelled out where you are safe and that it is only supposed to be used for this exact address?
That would be a very good question for some of our legal pundits. But after seeing this, I would basically look at the PPM and make sure that the funds sit in an escrow account until closing. And we know personally of certain sponsors who went and purchased properties, and they took the funds that were supposed to be used to renovate the property to go buy another property. We know of people who did that.
Absolutely.
And the property that they purchased, well, it's run down. They didn't fix it up, and those investors are going to face some problems because the value of the property hasn't gone up like it should have.
Yeah, there's going to be a lot of people caught, especially with the economy slowing down, with values slowing down and staying pretty stagnant. At least they're not receding, but people plan and forecast for appreciation and value, and it's just not there right now.
And if you go back to our YouTube channels or go back to one of the other podcasts where we did talk about why multifamily is in a little bit of a trouble based on the properties that were purchased at variable interest rates. Now those interest rates are resetting and they're not going to cash flow at higher interest rates. Well, if they didn't even renovate those properties and they used that money to buy another property, there's going to be some lawsuits, there's going to be some SEC investigations, and there's going to be some shakeouts.
Well, that was a good article that you wrote. It's on albanyparkcapital.com. Smoke good smokes, do your due diligence, and know your partners.
And, check us out on www.albanyparkcapital.com. Hit the resources button. We've got a lot of articles there. Subscribe to our YouTube channel and leave us some comments. We'd love to hear from you. We'd love to hear about our cigars. And we'd love to be able to provide more information on anything you might want to talk about.
We'll see you next time.
Have a good day.